Okay, let's unpack this. Welcome back to the deep dive. This week, we are going deep on a really rapid sequence of corporate moves by Strategy, the company that's, well, pretty famous for its aggressive Bitcoin Treasury model. We've gone through all the filings, all the analyst takes on what was, at the end of the day, a billion-dollar maneuver pulled off in less than a week.
Yeah, and Strategy is, they're known for their weekly updates, for being pretty consistent. But this announcement, even for them, it felt, well, extraordinary. The surprise wasn't really that they used their funding tool, the at-the-market facility, the ATM. It was the sheer staggering volume they pushed through it,
Yeah.
right after what everyone thought was their big defensive move.
Exactly. I think we need to really visualize the timeline here because the speed is just so key to understanding the whole thing. Just 1 week before this, Strategy locked down a massive $1.44 billion reserve. And that reserve was very explicitly designed to build, a fortress balance sheet. It was there to cover 2 full years of obligations, interest payments, you name it. It was their ultimate insurance policy.
And the market saw that. And the initial read was, okay, management's taking its foot off the gas.
Yeah.
They've got the cash they need, so they won't need to raise more capital for a while. That assumption was just completely shattered. Strategy turned right back around and issued almost $1 billion in additional common stock.
And the playbook is always the same, right? They didn't just sit on the cash. They took that nearly $1 billion and boom, immediately converted it. Over 10,000 Bitcoin bought in one big block.
Which brings us to the core paradox here for you, the learner, and it's a big one. How does a public company raise nearly $1 billion in new stock, turn it instantly into a famously volatile asset, and not have its stock price just completely collapse? I mean, this move, done so smoothly, it really challenges decades of traditional corporate finance theory on dilution.
Yeah, conventional wisdom, it would just scream that this kind of dilution should hammer the stock. You'd expect a sell-off, a price spiral, a loss of confidence, but that just isn't what happened. Strategy stock was, almost indifferent. It actually ended the week up a little.
And that indifference, that is the core data point of this whole deep dive. So our mission today is to break down the exact financial engineering here. We'll analyze why they chose the common stock ATM and explain precisely why the market didn't just absorb the $1 billion raise, but actually seemed to view it as a validation of the entire Bitcoin Treasury model's structural integrity. This isn't just a company buying Bitcoin anymore. This is a company proving its unique financial architecture actually works under huge pressure.
Okay, so let's start with the hard numbers. The scale and the speed are what make this so interesting. We're talking about a really compressed period here, basically between December 1st and December 7th. This was just a historically active week for their capital markets team.
It was an incredible sprint, really. The
Yeah.
total capital raised was just shy of $1 billion, $963 million specifically. And you have to remember, this came from 2 different streams of issuance, but one of them just completely dominated the whole process.
Can you break down those 2 streams for us?
Absolutely. So the smaller piece was about $44 million, and that was raised to their preferred issuance program. That's a mechanism they have that, it offers a specific yield, a certain priority in the capital stack. But the real powerhouse, the part that really shocked the market, was the common stock at the market offering, the ATM. That thing generated a colossal $928 million. That is nearly $1 billion of fresh common stock hitting the market in just a few days.
And within Strategy's framework, there's no question where that money goes. They use basically the full $963 million minus some transaction costs to execute one single massive Bitcoin purchase.
Precisely. That purchase got them 10,624 Bitcoin. Now, there's a detail here we really have to address right away because for anyone who follows this closely, it's going to jump out. The average purchase price was reported at around $90,000.
Wait, yeah, that number, that definitely jumps out. For people watching the market during that week, $90,000 seems really high. It sounds like they paid a huge premium over the spot price. What's going on with that average price?
That figure is so crucial, and it definitely needs context. When a company buys this much Bitcoin, over 10,000 in such a short window, they're generally not buying it off public exchanges. Doing that would cause massive slippage. It would drive the price up against them instantly. So they use over-the-counter desks or OTC desks. That $90,000 average price, it reflects the total cost basis. So that includes trading premiums, execution fees, and maybe other structured costs that come with doing a huge block trade like this discreetly and very, very quickly.
Okay, so it's not that the spot price of Bitcoin was 90 grand. It's that the all-in cost of acquiring that much Bitcoin without moving the market was $90,000 per coin. It reflects the urgency.
Correct. And for you, the learner, this is a huge sign of aggressive intent. The company was prioritizing speed of accumulation over, squeezing every last penny of efficiency out of the spot market. And this one move pushed their total Bitcoin holdings to just an astounding 660,624 BTC. So in context, this wasn't just another top-up. This was strategy showing maximum conviction using their whole financial machine.
Which brings us right back to the timing surprise. The ATM itself isn't new for them, but the shock was the scale of the common stock raise, almost $1 billion, and the fact that it came literally days after they'd secured that huge $1.44 billion reserve.
That reserve was, for a lot of people, the market security blanket. It covered every big liability they had, interest payments, debt service, the preferred share dividends. People did the math, and that reserve covered their obligations for almost 21 months.
So the logical expectation was, okay, the pressure's off, they've got their USD backstop, they can slow down, maybe they'll halt issuance for a while or shift to the preferred shares where there's no dilution. But it just seemed rational to think their reliance on new common stock would go way down.
And that market logic was just completely turned on its head. By issuing almost $1 billion in new common stock right away, Strategy sent a crystal clear signal. They were telling the market that the reserve was not a signal to pause, it was a signal to accelerate. They used the security of that fortress balance sheet as the launch pad for an even more aggressive opportunistic accumulation. They weren't raising capital to survive, they were raising it to seize what they saw as a major market opportunity. And that pivot from defensive one week to hyper-aggressive the next, that was the real surprise here.
It really was. It totally redefined their signaling. They built the fortress and then immediately used it to launch a much bigger attack on market supply. So now we have to get into the nuts and bolts of the financing tool itself. The key mechanism, the one that brought in 95% of the cash, was the common stock at the market, or ATM issuance. For you, the learner, let's just clearly define what an ATM is and why it's so much better for strategy than, say, a traditional secondary offering.
Well, the ATM is a really flexible capital-raising tool. So unlike a big secondary offering, where a company just dumps a massive block of shares on the market all at once, usually at a discount, the ATM lets the company sell shares incrementally at the market, directly into the natural trading volume over time.
Right. You can think of it like this. A traditional secondary is like opening a dam and flooding the market. The ATM, on the other hand, is like a controlled, steady drip of new shares into the existing river of liquidity.
That controlled drip is the whole key to its efficiency. You avoid that big price discount, which can be, 5 to 10% for large block sales, and it lets the company minimize the supply shock you can see, which reduces the immediate price hit. It's fast, it's continuous, and it's flexible based on what the market demand looks like in real time.
Okay, given that efficiency, the next big question is about the choice of instrument. Why lean so heavily on the common stock ATM and basically ignore the preferred stock, which is technically less dilutive for common shareholders?
The decision was just a brilliant, cold financial calculation. It was all about optimizing their capital stack. The sources were super clear on this. Their preferred stock was trading below par. And to really get why that's a fatal flaw for issuing more preferreds, we should probably quickly review what preferred stock even is.
Yeah, unpack that for us. Why is trading below par so bad for a preferred stock?
So preferred stock is this interesting middle ground. It's equity, but it has some debt-like features. It usually has a fixed dividend, and critically, it has what's called a liquidation preference. That preference is usually its par value. Let's say it's $1,000 a share. And that just means if the company were ever liquidated, the preferred shareholders get their money back before the common shareholders get anything.
So if that preferred stock has a par value of $1,000 and is trading on the market for, say, $950, that's below par.
Exactly. And if the company issues new preferred shares when the old ones are trading below par, they're essentially sending two bad signals. First, they're raising cash at a discount to the liquidation value, which is just bad financial engineering. And second, and this is worse, they're adding new claims to the capital structure that immediately increase the risk for the people who already hold the preferreds.
Because every new share they issue at $950 still has a claim for $1,000 if things go south. So the collateral backing that whole pool of preferred stock is getting stretched thinner for every dollar they raise.
That's it, exactly. Issuing preferreds below par signals weakness in the core collateral. It could even trigger a negative feedback loop where the price falls more. So Strategy's management, who are all about maximum efficiency, they would never intentionally weaken a part of their capital stack. Therefore, the common stock ATM, even with the dilution optics, became the more efficient tool right now, which is a purely logical, optimal choice driven by the market conditions at that moment.
But hold on. Wouldn't a common sense approach just be to wait? I mean, if they just secured $1.44 billion, why not wait a few months for the preferred price to recover and then go back to issuing those? Isn't issuing almost $1 billion in common stock seen by some people as a lack of faith in the long-term price of the stock itself?
And that's the real tension at the heart of this strategy. And it brings us back to this concept of opportunistic issuance. If they were operating under defensive pressure like they needed cash to pay bills, then waiting would have been reckless. But because that $1.44 billion reserve removed all that defensive pressure, this move was purely opportunistic.
Opportunistic in what way?
The opportunity wasn't in waiting for the preferred price to recover. The opportunity was in the Bitcoin price. We mentioned earlier Bitcoin was sitting roughly 30% off the highs. The management's job in a treasury company like this is to maximize Bitcoin accumulation. They looked at the market, they saw a chance to buy a critical asset at a huge discount to its recent peak, and they used the most efficient tool they had available, the common ATM, to fund that purchase immediately.
So this wasn't about desperation? It wasn't about paying the bills. This was an assertive, strategic move to deploy capital, and it was dictated by the price of the asset they actually want to own.
Precisely. The strategic logic is crystal clear. When your core asset is on sale, you use your most efficient, most liquid funding tool, and you don't worry about the optics. They saw the market conditions as a temporary window to accumulate aggressively. So the ATM, in this context, it wasn't a sign of weakness in the stock. It was a powerful statement of conviction in the long-term value of Bitcoin. They used the financial stability they had just built to fund that aggression.
Okay, this brings us to the biggest paradox, and I think the clearest challenge to traditional financial thinking. We saw this massive equity issuance, right? $928 million of new common shares. This is the exact kind of thing that in 99% of companies would trigger a catastrophic price drop. And yet, strategy shares finished the week slightly up, about 3% higher. The market just absorbed a billion-dollar raise without any stress. So what does this all mean?
It means the market has fundamentally re-rated this company. It's a whole different ballgame. For years, the conventional wisdom has been that dilution, just this simple increase in the share count, is a primary reason a stock's price goes down. The argument is simple. More supply should mean a lower price per share.
And for most companies, that's absolutely true, especially if they're issuing shares because they have to, which signals fragility or debt problems.
But Strategy's recent history, including this latest raise, completely contradicts that rule. We saw it with the $1.44 billion reserve raise just the week before. That was done using less than 5% of the average daily trading volume. It was basically invisible to the market. And this next billion was also absorbed without any forced selling or a price spiral. The shares were stable because the market understood the mechanics were sound and the capital was being put to efficient use.
Okay, so for you, the learner, this is the really crucial point to internalize. If simple issuance isn't driving the price down, what's the actual controlling factor? And this leads us right to the structural truth that we see in things like the price variance model, particularly the work from researchers like Adrian.
And that model gives us the key distinction. It's a simple sentence, but it's everything. Issuance doesn't drive price. Price allows issuance. That statement is really the foundation of the entire Bitcoin Treasury model.
Okay, let's do an explain it like I'm five version of that. If I'm an investor, why should I just ignore the supply shock of $1 billion in new shares?
Think of it this way. The main thing driving the stock price isn't the supply of the stock itself. It's the value of the asset the company holds on its balance sheet. Strategy stock is, for all intents and purposes, a high beta proxy for Bitcoin. When Bitcoin moves, the stock moves, because the vast majority of the company's value comes from its underlying BTC treasury.
So the correlation with Bitcoin is the dominant force.
It's overwhelmingly dominant. The analysis shows that the link between Bitcoin's price and Strategy stock price just dwarfs any other factor, including share issuance. The day-to-day change in the stock is almost entirely explained by how Bitcoin is doing. If Bitcoin is up 5%, the stock is probably going to be up a lot more, regardless of a little bit of dilution happening in the background.
So the market isn't reacting to the supply of the stock. It's reacting to the perceived value of the treasury that the stock represents.
Precisely. And that's why the ATM is a function of strength, not a catalyst for weakness. The company uses the ATM when its market price is strong, which is driven by Bitcoin. And that lets them issue shares at a premium to the underlying net asset value. The ATM is designed to harvest that premium, but it doesn't create the underlying strength in the first place. It just uses it.
What other factors, besides the BTC correlation, are big enough to just overwhelm that dilution effect?
The research points to two other really significant factors that explain price changes way better than issuance volume. First is options positioning. Big institutional traders, they use options to hedge or to bet on volatility. And when massive amounts of calls or puts are bought or sold, the hedging activity that follows can put way more short-term pressure on the stock price than the steady drip of the ATM.
Okay, and what's the second factor?
Sector rotation. We see this all the time, money moving between adjacent high-growth sectors. So, for instance, if there's a huge surge of interest in, say, AI infrastructure or some of the high-performance computing miners, that capital often flows out of assets like strategy and into those sectors. That rotation, which is really a psychological, momentum-driven thing, explains way more of the day-to-day volatility than just the simple act of selling a controlled volume of new shares.
So the ATM, the very mechanism that just raised almost $1 billion, is basically a statistical non-factor in the price movement. It's just overshadowed by options, sector rotation, and the huge gravitational pull of Bitcoin itself.
That is the conclusion, yeah. And what's more, the market understands the company's rules of engagement. When the stock is trading at a premium to its market net asset value, the MNAV, somewhere around 1.1 to 1.2 times, the market fully expects the ATM to be turned on. The whole point of the ATM is to capture that premium. The investors who buy this stock, they accept that mechanism as a core part of the accumulation engine. So the stability we saw wasn't market ignorance, it was market validation. They were validating the model's efficiency.
It's the ultimate vote of confidence, really. Investors are basically saying, yep, we see the dilution, but we believe the cash will be turned into Bitcoin so efficiently, and that Bitcoin will appreciate so much that it'll offset that dilution many, many times over.
Okay, let's shift gears a little and talk about the psychology here. The reaction to this billion-dollar raise was so different from how the market might have reacted to a smaller raise just a couple of years ago. That $1.44 billion reserve seems to have acted like a circuit breaker for fear. It absolutely was. That reserve was the single most important action in removing fragility from the model. Before that reserve existed, every time they used the ATM, it was met with some skepticism and stress. The question hanging over everything was always, are they raising this money because they're running out of cash to pay their bills? And that stress was a drag on the stock.
Right, but once that $1.44 billion was locked up, covering liabilities for almost 2 years, that question just, it vanished.
The whole market narrative flipped completely. Now, using the ATM isn't seen as a sign of financial stress or simple dilution. It's read as an act of aggressive, opportunistic Bitcoin accumulation. The market is now rewarding management for their ability to efficiently leverage their access to capital to grow the Treasury.
And we saw this sentiment shift everywhere, right? In the analyst commentary and the community chatter. Let's break down some of the key bullish arguments that really framed this as a win. We can start with the amplification effect.
Yeah, Adam Livingston really popularized that idea. He highlighted how effective the model is at scale. He pointed to the incredible pace of accumulation, over 200,000 BTC added just this year, a lot of it funded by these equity raises, and he calculated a Bitcoin yield of around 24.7%.
Explain that yield concept for us. It sounds a little like financial alchemy.
It's not alchemy, it's just leverage and efficient conversion. The Bitcoin yield is basically a measure of how fast the total treasury is growing, and it's achieved by selling a tiny fraction of the company, the equity, to buy the underlying asset, the Bitcoin. Livingston's point is that the company can issue stock at a good price, immediately convert the cash, and because Bitcoin appreciates, the net benefit to the existing shareholders is a massive increase in the underlying asset per share over time. The Treasury gets amplified.
Okay, but let me push back on that. Doesn't that amplification effect only work if Bitcoin keeps going up forever? I mean, if the price flattens out or drops hard, doesn't the ongoing dilution eventually start to overwhelm any gains you made before?
That's the critical long-term risk, no question. The model is highly sensitive to the appreciation of the underlying asset. But Strategy's entire thesis is built on the idea that Bitcoin is structurally scarce and will appreciate over the long term. So the amplification effect is really a measure of how efficiently they deploy capital inside that belief system. They're maximizing their exposure to the asset they think will deliver generational returns. So the continuous use of the ATM is them essentially compounding their bet. That's a fair way to frame it. Okay, let's move on to Dan Hillary's take. He focused more on the balance sheet's virtuous cycle. He called it the sweet spot.
Right. Hillary's analysis was all about the optimal balance between the different parts of the capital stack. He noted that issuing common stock, even with the dilution, at a slight premium to NAV, is highly efficient for common shareholders. But the key is what happens next. Every single new Bitcoin they buy immediately expands the collateral base for the preferred shares. So the common stock foots the bill for the Bitcoin, and then that Bitcoin turns around and reinforces the stability of the preferred stock, which sits higher up in the capital stack.
Precisely. It creates this sweet spot of reinforcement. The common equity is the engine for accumulation, and the accumulated Bitcoin is the collateral buffer that makes the company's senior debt and preferred safer. And that, in the long run, lowers their cost of capital and makes institutional debt holders more confident. It's a financial feedback loop inside the company.
We also saw some really powerful visual aids like Rohan's chart that showed the accumulation curve.
Yeah, and charts are often the best way to get a point across quickly. Rohan's chart was simple. It just showed the total Bitcoin holdings of Strategy over time, and you could see this almost vertical curve. That single image did a lot to shift the narrative from dilution fear to accumulation success for a ton of investors. The chart just proved that the model, when you run it aggressively, it delivers on its main goal, maximizing the pace of BTC acquisition.
And beyond those more structural takes, you had figures like Joe Burnett and Anthony Scaramucci weighing in, and they were focused on the broader strategy, the combination of all these financial tools.
Yeah, Burnett focused on the strategic timing. He talked about the design of digital credit, arguing that by combining common and preferred issuance, especially when Bitcoin's price is a little soft, Strategy is able to boost its effective Bitcoin yield. It's really about maximizing the BTC you get per dollar raised, using the company's high valuation to effectively buy the underlying asset cheaper.
That takes a really sophisticated sense of financial timing. They're issuing stock into a strong market to buy into a temporarily weak asset market.
Absolutely. And Scaramucci gave the perfect high-level summary of the whole sequence of events. The three-step process. Step 1, build the USD backstop. That's the $1.44 billion reserve. Step 2, resume equity issuance assertively, the billion-dollar ATM raise. And step 3, strengthen the balance sheet and the broader Bitcoin market by absorbing supply.
That framing makes it sound like Strategy's actions have implications beyond just their own company. Like they're positioning themselves as a systematic force that strengthens the entire Bitcoin ecosystem by being this reliable, big buyer during discounts.
That's the big structural takeaway, yeah.
Yeah.
Their issuance, turned into buying power, creates this large-scale demand that helps bolster the whole market.
Now, for the sake of critical thinking, we have to talk about the counterpoints. Even with a move this successful, there are always valuable dissenting opinions. Where did the main critiques come from?
The critiques mostly fell into two camps. One was focused on optics and dilution, and the other was about communication consistency. On the optics side, you had Rural Rider, who called it dumping $928 million of dilution near the weekly high. He was arguing that the MNAV was falling and that the move only serves short-term interest.
That sounds like the classic surface-level critique, right? It sees the new shares, ignores the efficiency and the asset that was bought, and just assumes the worst.
It completely fails to engage with the balance sheet mechanics. It focuses only on the flow, the new shares, and ignores the stock, which is the massive increase in Bitcoin collateral. The company acquired almost $1 billion worth of an appreciating asset. That's the core value driver, not the small increase in float.
Okay, what about the more nuanced critique, the one about communication?
Tristan raised a really fair point on communication consistency. They pointed out a gap between some earlier guidance the company might have given about future issuance and then suddenly doing this massive ATM raise at around 1.15 times MNAV. So this isn't a critique of the financial move itself, which was smart, but a critique of management's communication strategy. It's basically a call for more clarity on the exact triggers that make them decide to use the ATM.
And that kind of critique is valuable because it holds management accountable to having predictable, transparent rules for when they're going to tap the market.
And finally, you had Adrian, the researcher behind that price variance model, who was sort of the neutral voice in all of this. He just reiterated his core data-driven position. The ATM doesn't drive price. It follows price. His point is that the real discussion shouldn't be about if they diluted, but about why the market conditions were strong enough in the first place to allow for such an efficient raise. But the dominant sentiment was clear. The reserve removed the fragility, and now management is aggressively using every good market condition to scale their treasury.
Okay, so let's synthesize all this. The scale, the mechanics, the bullish sentiment shift. What is the definitive long-term bottom line for you, the learner, about Strategy's overall financial structure?
The conclusion is that the at-the-market mechanism isn't some temporary fix. It is the fundamental engine that built the treasury. Without the ATM, the company would own just a fraction of what they hold today. They wouldn't have 660,000 BTC. The ATM is the tool that continuously converts the market's premium valuation of their stock into tangible, appreciating assets on the balance sheet.
It's the engine that produces the collateral, and that collateral base is what everyone, from common shareholders to debt holders, really cares about.
Exactly. The ATM lets them use the market premium on their stock to buy the underlying asset efficiently. And we just have to underscore how transformative that reserve was. The $1.44 billion USD reserve completely removed the need for defensive issuance. And this means management can now use the ATM purely as a strategic tool, a way to maximize asset acquisition when conditions are right, instead of a survival tool to keep the lights on.
And when the motivation changes from survival to strategic accumulation, the whole risk profile of the company changes, doesn't it? How does that continuous accumulation of collateral translate into real long-term safety? You called it the chain of stability.
The chain of stability is this self-reinforcing loop that provides the structural floor under the company's valuation. It works like this. More Bitcoin means a larger, more liquid pool of collateral backing all their obligations, from the preferred shares to their convertible debt.
And what does that bigger collateral pool do?
It increases stability. More collateral reduces the perceived credit risk of the company for lenders and institutional debt markets. And that lets the company get better refinancing terms, lower interest rates, and access to more flexible credit down the road. Those tangible financial benefits directly reduce the long-term operating costs and the risk of a catastrophic liquidity crisis, which in turn strengthens the market price.
So, in effect, every Bitcoin they buy reduces the cost of their future financing and acts as this massive insurance policy against margin calls or a debt crisis.
That is precisely right. And more stability strengthens the long-term structural floor under the stock price for everyone in the capital stack. The common equity holders benefit because the company is less sensitive to short-term market swings and less likely to ever face forced asset sales.
And finally, this aggressive billion-dollar accumulation done so fast and with so much conviction right after they built their USD backstop, it serves as the ultimate belief test.
It really does. If you, the listener, believe in the Bitcoin Treasury model, if you believe the thesis that Bitcoin is a superior reserve asset that's going to appreciate significantly, then this is exactly the aggressive playbook you should want to see. A strategic treasury company should use every efficient tool it has to accumulate whenever the market gives them an opportunity, especially when the price is well off its highs. This assertive ATM use, backed by the safety of that USD reserve, is a powerful, calculated statement of conviction. It confirms that management believes the current price is a discount that they absolutely have to seize.
This deep dive has really shown us a textbook example of how sophisticated financial engineering, when it's backed by a strong, high-performing asset like Bitcoin, can fundamentally rewire how the market thinks about equity dilution. The biggest takeaway for you, the learner, is that the market price reflects the underlying strategy and the measurable growth of that asset treasury far more than it reflects the simple, mechanical act of selling new shares. The focus shifts entirely from the supply of the stock to the value of the treasury it's funding.
And that leads us to a pretty provocative closing thought. Strategy now operates with a massive USD reserve, which secures all their immediate obligations, and a rapidly expanding collateral-rich Bitcoin treasury. So, given this new, powerful level of stability, where their whole financial architecture is now fully validated, what does this aggressive playbook suggest about their conviction in the next major Bitcoin price movement? Will this strategic, opportunistic issuance become even more frequent, even faster, and even larger if, let's say, hypothetically, the price were to drop even further, offering even greater discounts to accumulate? That is the scale of commitment that this $1 billion move implies.
That's all the time we have for this deep dive. Don't forget to subscribe, and thanks for watching.